we are hurtling off the edge of the cliff into a recession. That recession, we've been forecasting, Julian Bittle and myself at Global Macro Investor, from about this time last year, actually. We saw it in the forward-looking data, and the current data is catching up. So we're now, I use the ISM as probably my best guide to the business cycle, and that's kind of at this 48 or so level, 47 point whatever level, and really just below 47 is 100% chance of recession. Now, all the forward-looking indicators like new orders are completely off a cliff. Employment, prices paid, you name it, every single indicator. We have a database of 1,500 indicators at Global Macro Investor, and it's all falling off a cliff. So this is the point where you get to on Twitter, where everyone goes, oh my God, there's a recession. Surely stocks are going to go down. No shit, Sherlock. They've already gone down. The Nasdaq went down 37.7%, I think, from the high. But what's interesting is that the forward-looking indicators are starting to suggest that we will hit the bottom of the recessionary wave in about April. So we're likely to get, I think, 2, maybe 3 quarters of negative GDP. But I think it's more akin to the 1990 style recession, which was the stock market fell 20%, the economy fell 2%, ISM went down to 40 or so. It all recovered. There was some overhang. The economy was slow for a while and then eventually recovered. A normal garden recession. That's what I think we're in the middle of. I think people are confusing prices, which is the unwind of the prices as in markets, the unwind of everything that happened in 2021 got unwound in 2022. And I saw Dario Perkins on Twitter calling it the A-shaped economy. So as opposed to a V shape, it was an A shape. So it went up, came back down, and it's reverted back to trend. So almost all of the charts have reverted back to trend. I think oil still got a bit of a way to go. Nat gas got there. Most of the commodities have got there. Most of these things are down 30, 40, 50, 60, 70% now, taking the inflation fears out. But this recessionary thing is what's in everybody's head. And the narrative in the market is, well, just wait for the earnings leg. Do you not remember 2001? Do you not remember the second leg in 2008? Those were very different styles of recession to that, in my view. Of course, I could be wrong. My guess is when I look at the rate of change of the S&P or the Nasdaq, they've all entirely priced in a recession. So the Nasdaq priced in an ISM of about 37, which is where my forward-looking indicator, my Global Macro Investor Financial Conditions Index, has been pricing the bottom of the ISM trough. And it's all coming around the same date. So what's happened is the markets have been forward-looking. They discounted the recession fast, and they're now starting to discount the pickup on the other side. And that's coinciding with the rate of change of Fed increases coming down. The ECB are the same, the Bank of England are the same. Everybody's slowing down their rate increases and are going to pause mode. Whether we get one more hike or not, I doubt it actually, but there's a chance we get one more pause. The bond market's starting to realize that that's probably the case as well. Also, global liquidity, M2 cycle, stuff like that, that's been picking up. It started with China, and it's going to start resonating throughout the world. Things like the falling dollar, falling commodity prices start picking up this kind of rate of change of liquidity. That also suggests that we kind of are bottoming around these levels. So we've got global liquidity bottoming. We've got the rate of change of interest rates that's taken the pressure off the neck. You know, Jay Powell's had his foot on the neck of the markets and the economy. So he takes his foot off, things can rise again. So that's kind of what stage we're seeing now. I think earnings have been discounted in prices. I know the bottoms up guys say, well, this is not right. And almost everybody on Twitter says that. I keep asking the poll. Everybody's still very bearish. All of the sentiment indicators everyone's maximum bearish. And I, using my macro framework I've been using for 18 years, I just don't think that's the case. Now, we're talking probabilities, not certainties. So anything can change here. But my view is that overall, is that the worst is behind us. It bottomed in October when I wrote a big Twitter article and a big Global Macro Investor piece calling it the bear market killer, which is October.